Michael Burry of Big Short fame has now put a massive bet on the US economy crashing.
Burry, the investor who became famous for predicting the massive 2008 housing market collapse in the US, appears to have recently placed a big bet against the US stock market.
Famous hedge fund manager and investor Michael Burry has made a name for himself for making some correct forecasts in the past, most notably for foreseeing the 2008 housing market meltdown that was featured in the film The Big Short. Today, we're going to discuss Michael Burry's concern about a market crash in 2024. The SEC reports that Burry is placing his bearish wagers against the S&P 500 and Nasdaq 100. Scion Asset Management, Burry's investment firm, purchased put options worth $866 million against the fund that tracks the S&P 500 and put options worth $739 million against a fund that tracks the Nasdaq 100. According to the documents, Burry is betting on a market fall with more than 90% of his portfolio. But Burry seems to have fluctuated this year between his positive and negative views on his stock recommendations. He tweeted a mysterious message to his 1.4 million followers in January. He scribbled, "Sell." However, he changed his mind before the end of March. He wrote, "I was wrong to say sell." This year, the S&P 500 and Nasdaq 100 have both seen significant rises. They're both up almost 16% and 34%. Burry was well known for betting against the housing market in the middle of the 2000s, and he made a tidy profit in 2008 when several significant financial institutions collapsed due to the subprime lending crisis. A movie based on Michael Lewis's best-selling book, The Big Short: Inside the Doomsday Machine, starred Christian Bale as Burry and detailed the event. Additionally, Burry's fund is selling its assets in several regional banks, including 150,000 shares in First Republic Bank, Huntington Bank, PacWest, and Western Alliance. It's unclear whether these sales occurred prior to or following JP Morgan Chase's acquisition of First Republic Bank in May. In the second quarter of the year, Burry changed his position on Chinese equities as well, dumping his holdings in JD.com and Alibaba. Burry and his Scion team are placing bets on certain names. Around 6% of the company's stock portfolio is long, and in the second quarter of the year, he extended his exposure to the travel and healthcare sectors by buying shares in Expedia Group, MGM Resorts, CVS, and Cigna. Burry also invested $3.3 million in online secondhand store The Real Real, and $4.7 million worth of shares in Warner Bros. Discovery, the parent company of CNN. Market speculation is undoubtedly a key idea in investing and finance. It refers to the practice of purchasing and disposing of financial assets, such as stocks, bonds, commodities, or currencies, with the main objective of making money off of brief price springs rather than retaining these assets for their intrinsic value or ability to generate income. Speculators often want to make money off of price changes that will take place over brief periods of time, which can be anywhere from minutes to days or weeks. They try to take advantage of market volatility by buying cheap and selling high. Comparatively speaking, speculation involves more risk than long-term investing. Due to the frequent use of high-frequency trading and leveraged positions by speculators, the potential for both big wins and losses is increased. There are several motivating factors for speculation. Speculators may follow trends in asset prices by making purchases during bullish momentum and sales during bearish momentum. News, current affairs, and market emotion can have a big impact on speculation. Negative news might cause a selling frenzy, while positive news can cause a buying frenzy. Speculators trying to profit from sharp price rises are frequently drawn to markets with high volatility. Markets with high volatility present greater trading opportunities, but also higher risk. Markets are affected in various ways. By aggressively trading, speculators increase the liquidity of the financial markets. Their presence makes it easier for other market participants to buy and sell. By reflecting on thoughts and expectations of all market players, speculations can aid in price discovery. As speculators trade, prices change in response to fresh information and expectations. Some contend that speculating increases market efficiency by promptly adjusting asset values to fresh information. Long-term investors seeking fair value gain as a result. Speculation carries a number of risks. Speculators have a high danger of losing money quickly and drastically, especially when using leverage in their trades. Speculators can make hasty decisions motivated by greed or fear, which would provide less than ideal results. High transaction expenses, such as commission and fees, can result from excessive trading and reduced profitability. Speculators sometimes concentrate their holdings in a small number of assets or marketplaces, increasing their exposure to certain risks. Concerns regarding stock market values are one of the main themes of Michael Burry's warnings, as well as frequently in the cautions of other market commentators. Calculating a company's or asset's present value based on a criteria like earnings, revenue, and growth potential is the process of valuation. A market bubble that can eventually burst can be feared when valuations become overinflated. A frequently employed statistic for assessing stock market valuation is the price-to-earnings ratio. It contrasts the market price of the stock with the EPS of the company. When price-to-earning ratios are significantly higher than their historical averages, it's been known to indicate that stocks are overvalued. Burry and others could be concerned that such overvaluation could not continue. The Shiller price-to-earning ratio, commonly known as a cyclical adjusted price-to-earning ratio, evaluates valuation by taking 10 years' worth of earnings adjusted for inflation into account. It eliminates transient fluctuations. Market downturns have traditionally been correlated with high Shiller price-to-earning ratios. High levels can suggest overvaluation and the possibility of correction. Financial markets are greatly influenced by monetary policies, notably those of central banks. Concerns regarding how central bank policies affect stock prices have been voiced by Michael Burry and others. Interest rates have been kept at historically low levels by accommodating monetary policies implemented by central banks around the world. Because of this, borrowing has become more affordable, encouraging investors to seek out larger returns in riskier assets like stocks. Investors may switch from stocks to safer assets when interest rates inevitably rise, which may cause a market slump. To add liquidity to the financial system, central banks have implemented quantitative easing programs, where they buy financial assets such as mortgage-backed securities and government bonds. These programs, according to their detractors, have artificially boosted asset prices, especially stock prices, and may cause a gap between market values and underlying fundamentals. The importance of speculation and euphoria in stock markets has also been noted by Michael Burry and other market observers. Speculative trading practices have been under scrutiny due to the emergence of retail trading platforms and social media-driven investment trends, including the GameStop saga of early 2021. Excessive speculating can cause sharp price changes and add to the instability of the market. Asset bubbles develop when stock prices, among other types of assets, rise dramatically above their inherent values. Speculative purchasing may be the cause of this. When a bubble pops, asset prices may drop dramatically, which could cause a market crash. Concerns about a future market crash can also be influenced by geopolitical tensions and economic uncertainty. Trade tensions between large economies like the US and China can wreak havoc on global supply networks, affecting stock prices and business profits. Economic downturns or recessions can have a detrimental impact on business profitability and investor confidence, which could lead to a market correction or crash. Financial markets can be significantly affected by unforeseen and uncommon events, also known as black swan events. One such occurrence in 2020 was the COVID-19 pandemic. Market crash warnings frequently cite historical examples, such as the early 2000s dot-com boom and the 2008 subprime mortgage crisis. These historic occurrences may be cited by Michael Burry and others to highlight the fact that market excesses and irrational exuberance can result in big market declines. Regardless of their forecasts, seasoned investors like Burry frequently emphasize the value of diversification and risk management in a portfolio of investments. In the event of a market turndown, risk can be reduced by diversifying investments among several asset classes. Investors can safeguard their cash by putting risk management techniques into practice, such as placing stop-loss orders or routinely rebalancing a portfolio. If Michael Burry has predicted a stock market catastrophe for 2024 or later, his projections should be viewed in the context of a wide range of insights and information. Markets can remain irrational for protracted periods of time, making it infamously difficult to predict the timing and causes of market crashes. Investors should be cautious when listening to market commentary, do their own homework, and base their investing choices on their own financial objectives, risk tolerance, and time horizon. A strong investing strategy must include diversification, risk management, and a long-term outlook, especially when the market is unpredictable. So it's critical to keep up with shifting economic conditions and market dynamics. If you've liked this video, don't forget to like and subscribe to our channel. Also, press the bell icon to get notified of our upcoming videos. Let us know your opinions in the comments section below.